Hey everybody, welcome to SumItUp. Today we're going to talk about cash flow. So cash flow is you have money coming into your bank account. You have money coming out of your bank account. So the difference between that is usually your cash flow. So if you have positive cash flow, you're building cash in your bank account. If you have negative cash flow, you're spending more than you make. What you should see is your cash flow should be going like this, up and up and up. We honestly, in accounting, I personally don't see it that often. Usually another trend that I see is either negative cash flow, where your cash is slowly going down, and you as soon as you get that money, it's usually gone, or it's
spent before you even get it, right? It's like, oh, I did a job, the money's coming in next month, and you've already spent your money. For us, I'm in a CPA firm. We have, our business is very cyclical. So in other words, sometimes in the year we're super busy when tax time comes around. And then in the summer, we're a little bit slower, right? And so our cash flow that Jordan's talking about, when we have the most cash, sometimes we do have times of the year where we spend more than we bring in because we have, jobs in the early part of the year and in the later part of the year, right?
You have a lot of things that you have to pay for up front.
So tons of businesses, I say that because you have, construction right now is booming. And so most contractors and things are doing well, but that's not always the case, right?
Exactly.
And so you're not always going to be taking more in 1 month than you spend. And that's okay if you balance your cash flow when things are good.
Exactly. So another trend that I usually see is usually a flat trend, meaning that usually the business has what we call a buffer.
How much, I should say, is a good buffer? You mentioned a buffer. In other words, how much cash should a business owner have in their bank account?
Well, it obviously is going to depend on where your business is at, right? A business that has $500,000 a year in revenue is going to be different than a business that has $5 million in revenue. Generally, I like to see at least about 10%.
Right, and I guess the answer to that, it was kind of a trick question. There's no simple answer, right? So I always
tell the accountant answer. It depends.
Yeah,
right?
And I always tell them, what do you want it to be, right? But no, it's it's definitely, you have to look at when is the cash coming in the coming months, and how much is your overhead. So if you don't have another job right now, how much do you have to spend every month anyway just to keep the doors open? And that's what I always tell them. Look at that. And the business owner, as much as I see tons of different clients, I don't know the answer. And right. So you have to look at what you spend every month. Even if you don't have jobs, you better have enough to cover that if revenue isn't going to be coming in the next month or 2 months. And so that's going to help you, hopefully, as a business owner, decide how much cash do I need to keep in the bank. And I do see it pretty common. They should have between 5 and 10% of their total income that they bring in. So if I have a contractor, he's a $10 million a year contractor, that's how much he brings in total billings. So he really should have $500,000+ of available cash, or something that he can pay his bills with if he has to. So that's just, hopefully gives you an example of how much, or kind of how to look at that and how much you should keep in the bank.
Yep. The next one I usually see is spikes. Okay, so the company will go along steady, and there's a big spike in cash. So that can happen for a few reasons. So that can be Kickstarter campaigns. That happens a lot. Their Kickstarter campaign, they get a bunch of people pre-buying their product. So when that hits their bank account, it creates a huge spike. And that's fine, but that catches up to them later when they're shipping out the product. That's when all the expenses hit, and that might be months down the road. So they really have to kind of plan for that and project their income out and their expenses so that they don't overspend as well.
This Kickstarter campaign, I compare it to like a contractor that when they start a job, they ask for 10 or 20% down. And so great, all this cash comes in, they've got, $20,000, $30,000, $50,000 of cash that just came in, but they haven't done any of the work, right?
Yeah.
So when the cash comes in like that, it looks good in the bank at the moment, but they actually haven't earned it. So we call that earned revenue. So anytime you're collecting cash, you haven't either delivered your product or performed a service, that cash isn't really yours.
Yeah.
And so when you're monitoring your cash flow, that doesn't really count in that buffer that Jordan's talking about.
The next thing I see is overdrafting, and this trend usually looks.
It's too common. That's
yes,
the problem.
it kind of looks like a saw blade, I guess you'd say. So they get the money, and it's gone. And usually they're hitting the overdraft in their account. Their cash is going negative. They get another boost of income, and it's gone again. So the problem is they're always having to rely on line of credit, loans, etc.
Or the next job, right?
Or the next job.
They're relying on the next job that they're going to getting that cash and paying for something that they've already spent. Yeah. And that's not a good situation.
And you don't want to rely on future income. And that's one thing I learned a lot early on in business is you don't want to say, well, you know, in the next couple of months we've got this big job coming up or this money that's supposed to come. You don't want to rely on those things. So really the most important things when you're thinking about cash flow is if you have a positive cash flow from month to month and it's increasing over time, that is one of the biggest things that show me that you have a healthy business. Because if you have a negative cash flow, I feel like you have an unhealthy business, and not only that, you're heading towards bankruptcy essentially.